As we await those earnings, let's bring in our market panel, though. Joining us now is Bespoke co-founder Paul Hickey and Annandale Capital chairman George Seay. Paul, we got it. 5K on the S&P and a new record closing high, although just shy of closing at that level. Is the trajectory higher from here, or are we now going to chop around and continue to test this key level?
Yeah, I mean, it's been 2 days. It would be perfect for it to happen on a Friday to close that level so everyone can think about it and celebrate over the weekend. But I think we still think there's more positives for the market here going forward than negatives. So we still have a bullish outlook on things. And for all the talk that we constantly hear about how this is all a Fed-driven market, how do you explain this week when expectations for rate cuts in March were all but priced out, and the market rallies and hits 5,000 for the first time? Since the expectations for a rate cut peaked back in late December, we've seen the S&P rally 5% and the NASDAQ rally 5%. And that's as expectations for rate cuts have come down. So the market is rallying on other things besides the Fed. And we've seen it in this earnings season where the results have been positive, but more importantly, the stocks have been reacting positively to those results. And that's an impressive trend that we've seen throughout this earnings season.
Yeah, and we should be very clear. Even though we got a new record for the S&P, we're only talking about a 0.06% gain for the broader market here into the close. George,
but up 2% since last Friday's employment report.
True. George, want to get your thoughts on this market, because the flip side of this is, and the argument goes, valuations, you could argue, are rich. We got segments of the market overbought at these levels, and it raises questions about how much near-term upside there really is now that we've hit this key juncture.
What a weird market, Morgan. It's really fascinating to watch. You look at Uber and you look at ARM today, and you look at PayPal and the regional banks. It just gives you whiplash with your head swirling back and forth between things that are performing super well and other things that are performing dreadfully, and the short sellers are feasting on it. So if it were me, I would exercise quite a bit of caution right now. You never want to jump all the way in or out of the market. You want to keep your positions on in areas that you're most favorable and attractive to. But I think right now is a good time to tweak things and to be cautious going forward. We've had such a run since October. It's been deliriously good, and you don't want to ever get overly exuberant and optimistic. That tends to end painfully. So,
I mean, it is telling that you have the Russell 2000, the small caps, actually the outperformer today, up 1.5%. And we keep talking about how the mega cap names and the tech stocks are the ones that are really leading the charge here. When you talk about exercising caution, what does that look like, and how much of that depends on a broadening out of this rally?
Yeah, exercising caution means writing some call options against positions that have had huge runs and buying some broad market put exposure on the back end, and maybe even leaving a little more than you normally do in cash and earn 5.25% risk free. I think that's a pretty hard return to fight against at these levels of the market. So if your normal cash allocation is 2% or 5%, I might take it to 8 or something like that. But just tweaking along the margins and keeping your core positions in place and not doing anything super drastic. Because as my colleague said, the market is acting really strong still. It really is. You wouldn't want to bet heavily against it. You just want to be a little more cautious.